All right, good morning, everyone. It's 7:15. We'll get rolling here. As always, if there are questions throughout, comments, please let me know, and we'll try to answer those as we go through, or feel free to send a message in the chat. So, quite a few things going on today. We still have crude prices doing what they're doing. Fertilizer values continue to firm. Some big swings in CFTC weather. We have two USDA reports today. The biggest one probably being acreage, but we also had the stocks report. And then we'll do a quick, brief recap on U.S. wheat export outlook and then price outlook. So, quite a few things that are going to happen today. We could see some pretty big swings as we move closer to those reports at 11 o'clock. So, starting on the crude side, we continue to grind here above $100. We tried to set back after that initial rally, the ongoing timing of when we will see some conflict resolution or the Strait of Hormuz opening is pretty unclear. If we go and look at the poly market wagers on 115, 120, $130 crude, there is quite a bit of wagers that we will see higher crude values, and a lot of that is, when will we actually see traffic return to normal out of the Strait of Hormuz? Um, Right now, the market's not betting that is very likely. So that's why we're continuing to see crude stay firm. The question is it going to be $100 and stay in this range, or will it continue to firm higher as we move forward? The wagers on when a U.S. Iran ceasefire will be, I mean, they're anywhere from May to, a lot of the market thinks it'll be by the end of December. But the timing of that resolution will have a big impact on crude values for, the near term, and also on fertilizer values moving forward, especially for the southern hemisphere, if they'll have the availability of stocks. So the 5-year chart on crude, we're trading back into what we saw in 2022. The question is, will we touch the highs we did there where it was $130 a barrel? Or, will we just stay consistent through here? So a lot of uncertainty moving forward. And when we start looking at how the funds have moved, I mean, they have covered their short positions in WTI. That has been the big push higher here. They have been longer in the past. In 2023, we saw them with significantly larger long positions. So there is room for the funds to make more of a push higher here. And that'll be, kind of dictate how high we can go here in crude values. Did want to point out that crude is inverted. May versus, even SEP of 26 WTI values. We have a $20 inverse. So the market is pricing in the fact they think the strait will reopen. But the question is just how far out in the curve are they willing to wager on seeing more of a normal flow of fuel coming forward. Showed this a couple weeks ago. $100 crude in the past has been $6 corn and $8 wheat. And, will the funds continue to roll into the commodities as an inflation hedge? And, that should be the bigger question, but that will come at the expense of the U.S. balance sheets. If we start getting overpriced, which we'll talk about on wheat later, but, we can trade higher, but it just makes the U.S. less competitive and creates, especially on the hard wheat side, us doing less exports and growing our balance sheet. Going to the urea side, I mean, continue to trade higher. The values on the top right were from February the 27th. We had no urea trading in the 450 to 465 depending on the shipment period. Now, similar trades are near $700. So a significant increase in value. The thing is, we do have the availability. So, it's going to cost more, but there is urea available. And when you start looking out in the forward curve of values, we see that it is also inverted like we saw for the crude markets. Wanted to show a different look at this. Stone puts out a fertilizer basic, how many bushels are needed to pay for urea. Back on February 27th, it was right around 100 bushels an acre, and that is sitting closer to 135 to 140 bushels to the acre today. So, the price rally in corn, has offset a portion of that, but, the break-even costs are growing considerably higher as we move forward here. So going into the CFTC report, we saw continued buying in soft wheat. We saw huge buying in corn, and then soft wheat or hard wheat and soybeans saw slight selling. Part of that is, we've already made the big move in beans. Hard wheat is getting uncompetitive in the world. So the question will be is, are they going to move to push another leg higher? There is room in all these markets for, another push to the long side. And with some of the reports today, that could kind of dictate the short-term moves we see. Specifically looking at corn positions going back to 2020, you can see we were somewhere around $8 corn, and the managed money positions were, 100,000+ contracts longer at that time. So there is more room for us to move higher in terms of how much length the funds are willing to put on. But, a lot of that is going to tie into the balance sheet side over the long run. Soybeans, we've made the move higher. We touched some of the long positions that were out there, not historic highs, but, near the top end of normal length that they will put on here over the past, 5 or 6 years. And the question is, does the balance sheet come into play more than the overall commodity inflation? So I think as we move forward, they're taking some of that risk off. There are plenty of beans in the world right now. So it will kind of depend on what corn prices do if they decide if they're going to add any more length to this position short term. The hard wheat side, we got long wheat for the first time since 2023. We've during 2020 through the Ukraine-Russian war, the position was considerably larger, but that was, kind of a different scenario where world wheat was questioning how much supply was available for the world market. Right now, there is plenty of wheat in the world market, and the U.S. Hard wheat is uncompetitive. So pushing this price and position higher just is going to, over the long run, make the position more bearish. Total wheat, we have had covering. The Matif position has been the largest covered position, going from a large short position to now, a slight long. Similar things that we've pointed out in the past 3 to 4 years. Every time we've gotten long wheat and had a decent world crop behind it, the funds have reestablished that short position. So the question, in all of these is, how long will the funds want to stay long commodities? So USDA reports today. The acreage report's going to be the biggest one. Questions on corn acreage, I think, is going to be the main driver. I think the consensus is about 94 to 94.4 million acres. Something like 93 million acres probably pushes us higher. And if we see, something 94 to 95 million acres, it's probably steady to bearish. So the key is for the market, it isn't so much the number, it's the number versus the market expectation. So the market's already trading, 94 to 94 and a half, and either side of that will, drive the nearby prices. The charts here just show some of the price changes on the acreage report days. I mean, there have been big swings either direction. So this report can have pretty big price swings associated with it. Stocks report is going to be, another portion of this, probably not as big as the acreage report. The market's expecting right around 9 billion bushels on corn and just over 2 billion on beans. So if we see something here that is drastically different, then that could also drive prices. But I think acreage is going to be the leading portion of that. And I think on the corn side for the stocks portion, people have questioned the feeding number all along. And will that show up today in the stocks report? The reduced feeding, well, USDA has increased feeding year on year, and, the market expects that to not be the case. So I think you could get some increased stocks that will then drive into the WASDE coming out in a couple weeks, and we'll have to see how that affects the overall balance sheet. But like I said, it's mainly going to be acreage that drives price value here in the short term. One thing to note is this is a survey-based prospective planning for the acreage. So this is all survey. That's why we do see some swings when we go into March intentions versus final. There are a lot of differences. We saw it last year. They came out somewhere around 95 million, I think, in March intentions. We ended up at 98.8. So this is just an initial estimate. And then as we move forward, we get more to the final planted acreage number. So ending stocks versus price, I do want to touch on the corn balance sheet some. As we look at the corn balance sheet today, we are very comfortable sitting right around 2 billion bushels. Looking out into next year, 94 million acres and a reasonable yield of 182, you still have a 2 billion bushel plus carryout. So when we're looking at price versus carryout, last year we traded sub $4 with a similar carryout. So if we're trading today 480 on new crop corn, then, the question will be are we too high valued versus the carryout? And that'll be something we'll have to watch long term. And that might not be a move that happens until we get closer to harvest. So moving into the wheat side, world weather, I think the biggest issue is still our region with dryness. We do have, some rain in the forecast, but as a whole, I think the world wheat crop looks okay. There are some spots that have issues, but we have a lot of time. We were in a similar position last year. The chart the graphic on the right was the drought monitor last year at this time. The left was this year. So, looking at the profile, yeah, we do have some more dryness in Oklahoma, but overall, year on year, it's not much different. We started to catch April rains and May rains, and, we were able to produce a pretty solid crop. So I wouldn't say that at this point the hard wheat crop is done for, but if we start getting rains, then we can reevaluate what we think overall production will be. And starting to look at some of the longer term forecasts, the seasonal drought outlook has us staying extremely dry. Part of that's tied into The La Nina weather event, you look for below average rain from May to September. So at least here in the short run, it doesn't look like we'll see the same pattern shift that we had last year. But at least in the 7 and 16-day forecast, we at least have some rain. We miss out in western Kansas and Colorado, but at least hopefully some relief for Oklahoma and central and eastern Kansas. Crop conditions, they are reflecting, every bit of the dryness we're seeing. We did drop below where we were last year at this time. And as we move forward, I think it'll take a few weeks. If we get rain here in the next 7 days, it'll be a couple weeks before that gets reflected in crop conditions. But, where we sit today, I mean, the crop is not in great condition, and we're going to need extremely timely rains to, make an average crop. So weekly price change. The hard wheat market has been pricing in this dryness. You look at its performance versus soft wheat, and 3% higher than the soft wheat rally was. And the market is pricing in this dryness, at least here in the short run, and that has made us extremely uncompetitive in the world. So we look at just fob on fob values. Hard wheat is $40 a ton over the Black Sea and $50 a ton over Argentina wheat, or even Baltic wheat. And we have seen, this price reflection come into play. We've heard of some Baltic wheat moving into the U.S. milling market. We're seeing Russian wheat move into Mexico. So price rationing here, we are losing demand. And as we go forward, last year we had July, August, Sep as an extremely strong export time frame. That let us get above 300 million in exports. If we miss that similar demand where we picked up non-routine business into Northern Africa, we picked up more Nigeria business, we start losing some of that during our key shipping time frame, and exports are probably more like a 250 to 265 in exports. So, you drop 50 to 75 million in exports year on year with a 400 million bushel carryout going in, and you can absorb a smaller crop and still have above a 400 million bushel export number. So, if hard wheat wants to keep rallying, it's just going to keep us less competitive for any export market and turn us back into basically a domestic market here. And then some of our routine business that we will historically do we'll still do Mexico and Central America, but, we'll miss out on some of that other business we did see this year. So price outlook, I mean, a lot of this is going to be driven by how long we stay dry, what crop ratings do. I also expect that we could see some acreage changes here that could keep hard wheat values higher, and the overall inflation trade versus crude, could keep us uncompetitive, at least here in the short run. So price targets 650 to 675 on July wheat. That's a little bit firmer than where we are today, but I still think if you are unmarketed for this crop year, it's worth taking a look at somewhere in this price range, and the carry structure is still allowing for marketing opportunities in July 27. We're sitting at kind of 675, 680 right now. So I think it's a good spot to get started, and then we'll just have to see what the world looks like as we move forward, especially the Southern Hemisphere. A lot of talk on Australia production concerns if they can't get fertilizer and their cost of production raises? Will we see as many wheat acres that we've seen over the last few years with their bumper crops that they've had over the last 2 to 3 years? So the last 10 years of marketing, I mean, we're getting into that upper 30% of prices. And if you took out 22 to 23, we would probably be in the upper 15%. So not a bad time, at least going back historically over the last 10 years. And when we start looking at the seasonality, I mean, it's weather markets and production. So April to July is historically the tops of these markets. So I think if you don't have anything sold for 26 or even have some parts sold, you need to take a look at any rallies that we do get here over the next couple of months and talk to your RMA and have price ideas in mind. It doesn't hurt to throw in an open order 50 cents above where we are because, a couple days move and you could get a price filled higher. Ending stocks versus price for wheat. This is all wheat. So, it's not hard wheat specific, but we're going to have a similar carry out to this year. And that is in the range of 5 to 550 wheat. So for us to be above $6 with this type of ending stock number, looking at 26, 27, I mean, it's happened in the past, but over the long run, if we trade purely on fundamentals and the balance sheet, we probably do find a time frame that we move lower back below $6 again. Going into soybean price outlook, I mean, we've put in the highs in March here for November beans. We're kind of grinding and looking to for the next really point of direction, which could be today's reports. But looking at new crop beans, 1150 to 1175. I mean, the market is pricing in us doing more Chinese demand. And how long they stay optimistic on that, will kind of determine where we are over the next couple of months. But the balance sheet remains comfortable. If we do get higher bean acres, that could keep next year's balance sheet comfortable as well. And very similar chart, April to July, seasonally, is when we typically get our higher values for the year. So having price targets in mind as we go forward, and we are nearing, once again, the upper 30% of bean values over the last 10 years. And, so it's something to look at if you have unsold beans for new crop. Lastly, corn milo prices. I mean, we traded similar values last year. We touched 475 for new crop corn last year and traded sub $4. But I think acreage is going to be the driver in us either rallying or, having the funds take off some of that length they've put on here. So quite a few things that could come into play in today's reports. And then, it's a weather market moving forward. So, we'll have to watch and see what that overall corn yield will end up. So I expect a lot of volatility in all these markets going forward. And, there's already talks of the weather pattern delaying corn plantings across the Midwest. So, there's going to be all kinds of topics that come up over the next 2 to 3 months, from too much rain to not enough. So it'll be something that we'll watch all the time. But I think for price target for new crop corn, somewhere in this 480 to just above $5 is a good spot to start. And same last 10 years, upper 30%, we're nearing that. And same seasonal chart on corn as we see for soybeans. As always, if you have questions, contact one of your RMAs or one of the traders. They're available at any time if you have questions. And yeah, that's about what I have today. Are there questions from anyone? If not, we'll
Yeah, Big's
roll
got
it.
one for you here.
Yep.
Yeah, what has the run up in crude done to ocean freight, and how has that affected us competitiveness on exports?
Yeah, I mean it's rallied ocean freight values. Just makes the freight spread. So not only, I mean, I think wheat is the most transparent in that, you've rallied wheat and you've increased the freight spreads. And that is going to make U.S. wheat into Africa and some other destinations less competitive. Just kind of expands that price spread that we're seeing on a fob to fob. So $40 fob to fob premium plus, a freight spread increase into a lot of destinations. Anyone else out there?
What's it done on like the fuel surcharge on shuttles going to the Texas Gulf compared to what it was a month ago? How does that calculate? Is it over a month time frame on average fuel prices, or how does that work?
I mean, Ryan, you probably watch that closer than I do, but yeah, you'll see fuel surcharges ramp up here.
Yeah, you'll see it ramp up. It'll be a little bit more delayed. I think it's based off of so like 2 months from now will be based off of this month's average highway diesel price. So we'll see a little bit of a lag as far as those increases. But we saw this back in Russia, Ukraine, where a lot of guys got hung on having stuff delivered and sold delivered, whether that was Mexico or California, and didn't have their fuel surcharge hedged. And I mean, there's instances where you thought you sold, 150 over California, and you really sold 125 over on corn or something. So yeah, it just creates more volatility, more hesitance to put deferred business on, and just kind of exposes a little bit more risk.